going to share the amazing potential and features of Roth contributions. First, a bit of history. Senator William Roth introduced legislation for these accounts, which was passed and made them available starting in 1998. You can think of Roth contributions as being synonymous with after-tax. In other words, you pay income taxes now on any money before you put it in a Roth account. There are a few ways to make Roth contributions. You can contribute earned income into a Roth IRA. IRA stands for Individual Retirement Account. And an employer-sponsored account, such as a 401k, 403b, or 457b, or in an IRA where a backdoor is used to convert it to a Roth. That backdoor conversion method is used when one's modified adjusted gross income exceeds the limits for direct contributions to a Roth IRA. What is your modified adjusted gross income? If you file a 1040 tax return, line 11 is your adjusted gross income. If you also have tax-exempt interest income, found on line 2A of the 1040, you simply add these together. The sum is your MHEI. If your income is below the phase-out limits and you can directly contribute to a Roth IRA, you can open this account at a brokerage firm such as Fidelity, Vanguard, or Charles Schwab. The income limit and contribution limits increase each year to account for inflation. The contribution limit is $7,000 this year for those under age 50 and $8,000 for those age 50 and older. If you have access to an employer-sponsored retirement account like a 401k, 403b, or 457b, you may have the option to allocate contributions as pre-tax, also known as tax-deferred, or as Roth contributions. The income you allocate as pre-tax are sheltered from being taxed now, so you'll pay taxes when you begin taking withdrawals from the account, usually in retirement. As a reminder, the income you allocate as Roth contributions are taxed now, and you will not pay taxes on withdrawals in retirement. How much you may choose to contribute and how much you allocate as pre-tax versus Roth or after-tax to these accounts is situation dependent, but one rule that never changes is you should always take full advantage of your employer match. Many employers match your contribution up to a percentage, usually 3 to 6%. So if your employer matches contributions up to 5% of your salary, this means when you contribute 5%, your employer will match that dollar for dollar. Employer match dollars is free money. Don't ever leave it on the table. If you allocate your contributions as Roth and your employer matches, you could have supercharged growth. Experts believe tax rates will increase in the future, so having some income from after-tax sources is just smart planning. Roths are one of 3 financial vehicles in which growth is not subject to capital gains taxes. I'll get into details on this concept in another video. The potential for growth in Roth accounts is enormous since they do not experience capital gains taxation. Another great feature of Roth IRAs is that they do not have required minimum distributions. RMDs are withdrawals you must take from certain retirement accounts starting at age 73 under current or 2024 IRS rules. So if you have sufficient income from other sources, you can let the funds in a Roth IRA continue to grow and leave it for beneficiaries. Know that RMDs would come into play for those account beneficiaries if you were to pass. Employer-sponsored accounts, such as 401ks, are subject to RMDs. I want to highlight the importance here of designating beneficiaries on all your accounts. This is an important estate planning fundamental that keeps the accounts outside of probate if you were to pass, and it lets them pass directly to your intended beneficiaries or a trust if you have one established. To make withdrawals from Roth IRAs and employer-sponsored accounts, you must be 59 and a half or older, and for Roth IRAs, the account must have been open for 5 years. There are a few exceptions to this where taxes and penalties would not be owed. Uninvested contributions in a Roth IRA can be withdrawn at any time. Do you want to learn more? Contact our team via direct message or cell phone at 205-725-0250.